Good afternoon. Welcome to our webinar today on the marginal cost of funding. It is the first in this four-part funding products webinar series put on by your cooperative, the Federal Home Loan Bank of Des Moines. Before we start, if all of you could signify that you can hear me, there is a button on the left-hand side for you to raise your hand. If you could click on that button and let us know that you can hear us, we would greatly appreciate it. All right, good afternoon. Good afternoon to our members in the Central and Mountain time zones, and good morning to our members in the Pacific and other Western time zones. My name is Brad Spears. I'm Vice President, Director of Member Relations for the Federal Home Loan Bank of Des Moines. I'll be joined during the presentation on marginal cost of funding by Brett Manning, Senior Vice President, Funding Products Group Director in Seattle. And I want to cordially invite all of you for listening in on the first webinar of a four-part Funding Products webinar series offered by your member-owned cooperative, the Federal Home Loan Bank of Des Moines. Specifically today, we'll focus on the concept of marginal cost funding, which gains importance because of the fact that we're coming out of a zero interest rate environment, and we've seen the FOMC raise rates several times. Today's webinar will focus on the concept of marginal cost funding. In particular, we'll focus on how to utilize a quantitative framework for evaluating the relative attractiveness of your retail deposit pricing campaigns and why it's important to do so. We'll walk you through some defensive strategies and some offensive pricing strategies, and we'll give you a background on marginal cost of funding. We hope that this will be an informal and interactive session. We encourage questions. So if at any time you have a question, please type your question in the group chat box, and we will get to your question in the Q&A session at the end of the webinar, and we will answer them in the order in which they were received. So let's move to slide 2. Here is our agenda for the presentation. We're going to give you some background on marginal cost of funds. I'll turn the microphone over to Brett Manning. He'll walk you through some defensive strategies. These are strategies where you're actually the prey. You have competitors or other institutions coming after your customers, either by offering new products. Maybe they're trying to make a splash in the marketplace. They're a new entrant. And then Brett will hand the microphone back to me, and we'll talk about some offensive strategies where you are the predator. You are actively and aggressively pricing your deposits to gain some funding. And then we'll end up with some question and answers. As I mentioned, just type your questions into the chat box, and we will answer those at the end of the session. We will start today's webinar with a poll question. How many of you use marginal cost of funding in your daily deposit pricing decisions? Simply choose yes or no, and we'll quantify the results. We'll give you about 30 seconds. We'll quantify the results. So it looks like about a third of you do and about two-thirds of you don't. So I'm glad that you're on this webinar, because that's one of the main topics that we're going to discuss. That is one of the questions we want to answer for you. Hopefully, after listening on this webinar, you will start looking at the marginal cost of funding when you're pricing your daily deposit prices. Move on to slide 4, please. Let's give you some background on the marginal cost of funds. Marginal cost of funding is a process or a way of thinking and evaluating the pricing of deposits in comparison to your competition. Sometimes it's described as a tool. We have a tool at the Federal Home Loan Bank that many of you, all of you will receive after the webinar is completed. It's a process, or hopefully it becomes indoctrinated into your organizational culture. It can be used to compare the marginal cost of new money obtained from a deposit special with the cost of borrowing the same amount from the Federal Home Loan Bank and other benchmarks. Whether it's the ZIRP policy, a reallocation of deposit dollars, or both, most would agree that institutions will ultimately come under pressure to retain existing deposits or replace those that are lost with other sources of funding. The FDIC calls these surge deposits. We saw at the Great Recession a lot of money flew into the financial institution market, and there's a question as to when the timing of that money will flow out. Hence the term surge deposits, and it's the reason why the FDIC is concerned about your liquidity plans. The million-dollar question is, when will this pressure materialize? When it does, how will you address it? How will you marginalize your cost of funds, the amount you pay for deposits as compared to the cost of alternative funding vis-a-vis wholesale funding? So we'll attack it first from a mathematical perspective. If you think about marginal cost mathematically, it is quite simply the relationship between the change in a cost of deposit divided by the change in the balance of the deposits. You see the formula right there. Everything in life can virtually be solved with math. So we're going to look at it from a mathematical perspective and a formulaic perspective to get a better understanding of why it's important and how it works. Quite simply, it's a way to determine how much your deposit pricing campaigns actually cost. What is the true cost at the margin for those funds you've received? It can come in many forms. Defensive strategies are responding to competition, market movements, or some competition of the two, which Brett will talk about. And I will talk about offensive strategies, developing new deposit markets, perhaps new deposit accounts and new depositors. And the Federal Home Loan Bank can help you assess marginal cost of funding in a number of ways. Slide 6. Many of you have probably seen an inordinate deposit growth over the past few years. It's been a very tough environment to invest these low-cost source of funding. But still, nothing lasts forever. What will break the snap? Will it be the end of the zero interest rate policy, reallocations of deposit dollars? Either way, you'll need to assess your cost of funding, not by gut, but based on what the competition is offering, but instead by looking at how much it costs to fund your financial institution at the margin. That's the reason for our webinar today. You need to take into account the impact on your total funding cost for each increment of financing. You could be looking at a number of different funding strategies, including new product promotions, perhaps tapping into new market niches, or even assessing wholesale funding avenues. Irrespective, you need to consider your marginal funding cost in order to avoid overpaying for deposits that you, quite frankly, were never in danger of losing. With the harsh reality that whenever you change your deposit gathering strategy, you run the risk of attracting the attention of existing deposits and placing them into categories that bear higher funding costs. So slide 6 starts with marginal cost of funding can help you do a number of things. It's more than modeling. Hopefully it's cultural. And that's really what we want to leave you with today is it should be involved when you're pricing your deposits. You should consider the marginal cost of funding. If you do, it will help you minimize the cost of growing your deposit base. It will help you measure the impact of creating new deposits. It will also assist you in segmenting rate-sensitive and non-rate-sensitive depositors. Hopefully, it will allow you to assess the degree of cannibalization of existing deposit bases. And more importantly, and perhaps more pressing, it will assess the impact of rising rates on your deposit pricing campaigns. We have a quote from Eleanor Roosevelt down here at the bottom of the slide, and I'll read it for you. You wouldn't worry so much about what others think of you if you realized how seldom they do. Marginal cost of funding should be a cultural perspective. You should be analyzing it, looking at it. You can reap a lot of benefits by doing so. Slide 7. We'll move forward. So when you're running any model, there are always assumptions to contemplate. As you know, in your interest rate risk model, you make a lot of major assumptions, none more important than how sensitive your deposits are to movements in interest rates. The marginal cost of funding tool is very similar. It's going to try to quantify how you respond to competitive pressures. Do you raise rates or do you stand pat? Do you want to meet the competition or do you want to let that business walk? You also have to contemplate your depositor rate sensitivity. What percentage of your deposit accounts are truly rate sensitive? Do you know that? Do you have the means to understand that? Knowing that would be a very important tool when you are pricing your deposits. Do you know what your deposit betas are? How do they respond to market rates and FOMC rate hikes? How sensitive are your non-maturity accounts to movements in interest rates? We've seen a massive migration over the last recession of money, as I mentioned, into the banking industry, but out of certificates of deposit into non-maturity money market accounts. One of the other assumptions we need you to contemplate is whether or not you're going to acquire new deposit accounts. How much are you willing to pay up or price up for a new deposit market? Some more assumptions to contemplate. The impact of cannibalization. If the deposit balances are not new to your institution, where do they come from? Most likely they come from a lower costing source that now reprices at a higher rate as a result of you running this special. So knowing what your cannibalization rate of your existing deposits is important because it helps you quantify your overall marginal cost. Also, what is your alternative funding source? The Federal Home Loan Bank can help you here. We want to be the lender of first resort, not the lender of last resort. We're a time-proven partner, a time-proven option for all of our institutions. You need to, when you're buying a car, you compare cars. You compare a Chevy to a Ford. It's the same way with if you're raising deposits retail. You're going to look at what your alternative funding sources are, and you're going to compare the two at the margin. So the question arises, when do you apply marginal cost of funding? And hopefully you'll see that shifting to a marginal cost of funding mindset will help you minimize the cost of obtaining additional funding and growing your deposit base. Hopefully it will force you to think about how rate-sensitive members might impact any incremental deposit growth, as well as how varying degrees of rate sensitivity might alter your cost of obtaining funds in a rising rate environment, which is what we're confronted with at the present time. Slide 9, please. These are the campaigns that Brett's going to talk with you about here in the subsequent slides. Defensive pricing campaigns. This is where you're more reactive as opposed to being proactive. An attack has been lobbied at your institution. In other words, someone is coming after your competitors. Are you going to respond to their competitors' rate moves? Are you going to respond to market events? Or are you going to respond to Chairman Yellen and the committee raising the federal funds rate? These are campaigns where you are the prey in the predator-prey relationship. Someone is coming at your customers by offering perhaps a new product, offering CD specials, offering high-rate checking, trying to get to your low-cost sorts of funding. It can also be applied from an offensive perspective. It's commonly said that the best offense is a good defense. Well, in this case, what we're talking about here is a more proactive pricing campaign. You are the predator. You are trying to attract deposits. Perhaps you're making interest into a new market, or you have a competitor that's vulnerable. You are trying to gain deposits from your competition. Perhaps you're developing new deposit markets. Maybe, hopefully, you're raising new funding for growth, loan growth. Or perhaps you have a new product, a high rate checking account, or some other type of new product that you're going to bring to market. You'll want to be offensive when you do that. You will want to price as attractive as you can at the margin to attract the business. Slide 11. Before we progress, we'll go through some definitions here before I turn the microphone over to Brett. Rate sensitivity. You see the definition right there, how the rates paid on your retail deposits are impacted by changes in interest rates, how these rates either increase or decrease according to changes in interest or market rates. The deposit betas, they measure deposit rate changes, and they're typically expressed as a percentage. So if your money market deposits are assigned a 35% beta, that means that if market rates either decrease or increase, the rates paid on these will adjust 35 basis points downward or upward, depending upon which way market rates move. We talked about cannibalization a couple of slides back. This is an important concept when you're analyzing the marginal cost of funding alternatives. It's a negative impact of a new deposit product or CD promotion and how that what kind of impact it has on the rate performance of your institution's existing and related products. We'll also talk about funding alternatives, sources of funding outside of your customer base, of your existing deposit base, typically referred to as wholesale funding. These are Federal Home Loan Bank advances, brokered deposits, quick wait CDs, public unit deposits. These are alternatives outside of your deposit base. So I'll throw the microphone over to Brett Manning, and he's going to lead you through defensive strategies.
Yeah, thank you. Thank you, Brad. I'm Brett Manning, Director of the Funding Products Group at the FHLB Des Moines. And over the next 10 minutes, I will walk you through a case study which applies our marginal cost of funds tool to defend your existing deposits against the market activities of your competitors. Though this is just an example, this pricing exercise is something we see nearly every week. As Brad mentioned, marginal cost of funds can be an organizational culture, a day-by-day quantitative assessment of your deposit costs. Any good assessment includes a careful consideration of assumptions and market variables. Now let's walk through the background of this case study. If you're in the business of offering 2-year certificate of deposits priced at 1%, and depositors have noticed attractive rates at a local competitor for the same term but priced at 125. Now the question is, do you match the competitor's rate of 125 or stand pat at 1% and hold the line? Again, a careful assessment of pricing assumptions is imperative. In this example, we believe $20 million in existing deposit funds are close to maturity from other term CDs you offer, and nearly 20% of this balance will jump to the competitor's product priced at 125. Your trusty alternative source of funds, the FHLB Des Moines, prices their 2-year advances at 167. This is your alternative cost of funds, should you choose to stand pat, hold the line at 1%, and replace those lost deposits that jump ship. Now with that as a backdrop, the FHLB Des Moines has a tool to help you quantify these pricing decisions. With a set of basic assumptions, we can then determine what pricing strategies make sense and which ones don't. So let's take a look at the tool and see how this strategy prices out. Next slide, please. We try to make quantifying the marginal cost of funds a simple process. In this case, a simple 3-step process. This screen is an example from our marginal cost of funds tool. First, let's consider our assumptions on this 2-year CD offering. As we mentioned on the previous slide, we believe 20 million may be interested in leaving the institution to find higher rates elsewhere. The FHLB offers 2-year money at 167, quite a bit higher than the current rate paid, 1%, and even quite a bit higher than the 125 that your competitor is currently posting. Furthermore, you believe that of this 20 million, 20% or $4 million are rate sensitive and will leave your institution to seek higher rates with the competition. So step 1 is complete. You have the tool, which you can download from our website. We have contemplated parameter values to assess the marginal cost of funds. You have all the ingredients to make a sound and informed pricing decision. So next, let's see what the tool tells us. Given the rate-sensitive nature of your depositors, does it make sense to price up to the competition at 125, or should you stand pat and hold the line at 1%? Like all good mysteries, The storyline is often in the details, and this example is no different. Next slide, please. Here's step 2. Let's review the analysis or defensive case study. Based on the $20 million we have earmarked as near maturity or willing to terminate, we believe 20% of this balance, or $4 million, is truly rate sensitive and will jump at a moment's notice for higher rates. The balance of this account, $16 million, is not rate sensitive, and you have no risk of losing these balances due to a competitor's pricing activities. So we have completed step 1, which is to consider your assumptions. We have just finished step 2, which is to quantify the rate sensitivity of your deposit base. Step 3 is the final act. Do you match the competition and pay up to keep and defend your deposits, or do you stand pat and let the rate-sensitive customers seek higher returns from the competition? Next slide, please. Step 3 involves looking at the details of your 2 pricing strategies. The first strategy is to hold rates constant, to stand pat, and let your rate-sensitive customers walk. Why would you do this? Well, one reason is because you think that the cost of paying everyone the higher rate is not economically prudent. Why pay up for balances that you were never at risk of losing in the first place? If we dive into strategy 1, you will see that the cost of standing pat results in a marginal cost of just 67 basis points. Why is that the case? Well, you didn't pay your non-rate sensitive depositors the higher rate. They're standing pat at 1%. Thus, there is no change to your interest expense for this segment of the balance, or $16 million. Secondly, you replaced your rate-sensitive balances, the $4 million, with an FHLB advance priced at 167. Thus, the marginal cost of this retention strategy, strategy 1, is the change in the cost of your deposits divided by the change in your balances. In this case, the change in the interest expense is paying up 67 basis points on the $4 million that is rate sensitive divided by these rate sensitive deposits. Again, the change in cost divided by the change in balances is your marginal cost. This is much lower than the rate of 125 your competitor is willing to pay. Next slide, please. What about strategy 2? Let's just check to see if you match the competition and pay up to 125 and see what this will cost your institution. Well, it's quite simple math, quite frankly. If you pay everyone the higher rate on the $20 million of balances at risk, the marginal cost is simply 1.25%. You can clearly see that paying up to match the competition is a much more expensive solution than just to stand pat and let your rate-sensitive depositors leave your institution. In this case, it's almost 2 times more expensive. What this does is it really boils down to keeping that back pocket special available to your pesky rate-sensitive depositors and not let the motives of a small slice of your deposit base shift your pricing decisions. Paying up to retain deposit balances that you were never at risk of losing is never a good idea. But when is it a good idea to pay up? Surely there has to be some scenario where this makes sound economic sense. Again, next slide, please. But before we jump to that, I do want to provide a simple reminder. Again, paying up to keep your balances you were never at risk of losing results in paying 55 basis points more than just standing pat. Quantifying deposit pricing ideas before offering products is just one helpful element of the marginal cost of funds construct. Of course, it's never as easy as putting some numbers into a tool and magically coming up with the best answer. Not all depositors are valued the same way. Some may have valuable loan business, and others may provide sources of great fee income. We understand this, and furthermore, we understand the limitations of just looking at the numbers. But we can't help ourselves. Let's keep looking at the numbers to figure out when this would make sense. When would paying up to match the competition make economic sense? Next slide, please. Given the current assumptions, standing pat or holding the line at 1% results in a 67 basis points marginal cost as you replace your rate-sensitive deposits of $4 million with an FHLB advance priced at 167. But when would it make sense to match the competition and pay up to 125? Well, if the rate sensitivity of your deposits at risk is 37.3% or higher, it makes more sense to pay up and match the competition and pay the 125 than it is to borrow from the FHLB at 167. Why is this the case? Because at a rate sensitivity of 37.3 and above, it's cheaper from an interest expense basis to pay up than it is to replace with an FHLB advance. The marginal cost of paying up is 125, whereas the marginal cost of an FHLB advance is 167, and a rate sensitivity balance of 37.3% is the line of demarcation, so to speak. As you're at risk of losing more and more of your balances, paying up becomes a more viable strategy given the assumptions provided. Net, in this case, if you believe that your rate-sensitive depositors are near or above 37.3%, just pay up. Enough of them are asking for higher rates and will vote with their feet if they don't get them. Losing these balances is just not worth it. Next slide, please. Now here's the same story, but by using our marginal cost of funds tool. Again, you can see that at a 37.3% rate sensitivity bogey, the marginal cost of strategy 1, which is to stand pat and hold rates constant, and the marginal cost of strategy 2, which is to match the competition and pay up to 125, are one and the same. What's great about our marginal cost of funds tool is that you can change the assumptions as you see fit to assess the what-if scenarios that you brainstorm. This tool is a great way to quickly quantify your pricing decisions. Next slide, please. Now, in summary, when evaluating the cost of retaining existing deposit balances and defending your turf and paying up for deposit balances that you were never at risk of losing, that can be very, very expensive. You need to quantify your pricing decisions on a marginal basis. To mitigate this risk, actively segmenting your deposit base between rate sensitive and non-rate sensitive can be very beneficial as rates rise and depositors seek higher returns either from you or from another provider. Having just-in-time access to wholesale funding is also imperative to manage your institution's liability costs. Parlaying your credit line and advanced access with the Home Loan Bank of Des Moines and our tools, such as the Marginal Cost of Funds tool, may prove to be a winning hand to defend against competitive pressures as interest rates rise. Now, with that said, I'll hand the mic back to Brad Spears, and Brad will walk through an offensive case strategy to generate new deposits. Brad, back to you.
Thank you very much, Brett. We apologize for the technical difficulties. No matter how many times you test things, it always seems like when you go live, something happens. We've survived the flood. I guess we can survive technical outages. We apologize for that. Thank you so much for your patience, and thank you, Brett, for hanging in there. So Brett described a pricing strategy that kind of resulted from a direct or indirect attack on your deposit base. This could be from an institution that's new to the marketplace and wants to make a splash, or it could be that a local competitor is running a special to attract new business. In the examples he gave, your institution was the prey. Your business model was being attacked by an outside force. I'm going to describe several scenarios where the script is flipped, and your institution is the predator and is actively and aggressively pursuing pricing strategies to bring in deposits. But before we get into these, we got another poll question here. And the poll question is, how many of you saw money flow out of CDs into non-maturity deposits during the last crisis? Give you 30 to 45 seconds to answer. Good. There's the results there. 85% yes, 15% no. And during the last financial crisis or Great Recession, money poured into financial institutions, as I've mentioned previously, at levels that we had never seen before. These deposits have been referred to as surge deposits by the various banking regulatory bodies. It has created a lot of anxiety at the regulatory level. Just how sticky are these deposits? Does your institution have a liquidity plan in place to replace this funding if it leaves the institution for a better alternative product? So we're going to talk about now on slide 24, offensive strategies, and why would a financial institution deploy an offensive deposit campaign? They are designed to go after market share, quite simple. You need funding, you want to go after funding, you're making a splash into a new market, you want to grab market share, you're going to go on the offensive when you're pricing your deposits. Institutions often play offense to steal other competitors' deposits. Perhaps you have a competitor who's vulnerable. We saw a lot of this, and it still continues to go on. When the Great Recession hit, we saw a lot of financial institutions get in trouble. Asset quality became a concern, and the ones that didn't have asset quality issues had an opportunity to go after those vulnerable deposits. Maybe you want to put out a new deposit product or a CD special. You can introduce it to help identify existing customers that are rate sensitive. Knowing which of your customers are rate sensitive is a very valuable tool. And it is something that if you indoctrinate marginal cost of funding into your culture, you will be able to do that. You'll be able to identify how many of your customers are rate sensitive, because as Brett talked about, you don't want to price up your deposits when you have no risk of losing them. You should only run offensive campaigns when the marginal cost of additional funding is not substantially above a determined market bogey. And we have a quote here from one of my heroes, George Washington. It says, "Make them believe that offensive operations oftentimes is the surest, if not the only in some cases, means of defense." So slide 25, please. We'll talk about how you establish a market bogey. Institutions should develop a benchmark rate for every deposit account. Every single deposit account that you have should have some type of benchmark rate. My request to you is that you look at using the Federal Home Loan Bank advance curve. If you model interest rate risk, a lot of times it's used as your indifference curve because it is a substitutable deposit product for you. The benchmark rate will help you identify which deposits are well priced and which are not priced at the margin. The Federal Home Loan Bank of Des Moines makes our pricing curve available each day. The rates are free. Published daily at our website there, we have a link to our advance pages. We offer a complete array of funding products. Now, I'm not advocating that you have to use Federal Home Loan Bank products. I'm advocating that as a proxy to pricing your deposits, you can use our advance curve. If you're thinking about offering a one-year CD, take a look at what you can get one-year money from the Federal Home Loan Bank from. We offer a complete array of funding products, and we are the second largest issuer of debt in the world, only behind the federal government. So when you are pricing deposits, when you're making pricing decisions, it is important to establish a market bogey. It doesn't have to be the Federal Home Loan Bank curve. You won't hurt my feelings if you don't use the Federal Home Loan Bank curve. But it is readily available and is recognized as a market-driven curve. Slide 26, please. Brett walked you through the marginal cost funding tool on a defensive strategy. He mentioned it was a two-step process. In his case, it was three-step. For the offensive, it's two. Step one, we're going to enter the values for all the parameters in the yellow cells. So we've got our existing total deposits of over $446 million. We want to raise $10 million. And we want to offer a one-year promotional CD rate of 130. Now, I go to the Federal Home Loan Bank and I call my rep and I ask them what one-year money is going for, and they tell me 145. My current rate on my existing deposits right there is 54 basis points. As you can see, I've entered a cannibalization rate of 2%. That means that typically when I run a CD special or campaign, I can expect 2% of my deposits to flow out of lower costing alternatives to take advantage of the special rate. So 2% of $446 million is almost $9 million, $8.9 million. So even though you want to actually raise $10 million, you in essence raise almost $19 million. So what we want to quantify is what is the marginal cost of this money that you've received. Slide 27, please. I talked early on about what to contemplate, what your assumptions are. So your first step is to consider 4 assumptions. How much are you looking to raise? In this case, it's $10 million. What's our promotional rate? What are we willing to pay for that new account? In this case, it's $130 for a 1-year CD. What does the alternative cost you? We're using a 1-year Federal Home Loan Bank advance. It cost me $145. What's my cannibalization? What are the hidden costs of deposit pricing and promotional campaigns? Even low rates of cannibalization can significantly diminish the economics of promotions. So it's important that you know what that cannibalization rate is, because that's really what drives the decision-making process. Slide 28, please. Here's the second step. We're going to review the analysis. Once again, as Brett mentioned, this is our marginal cost of funding tool that we will make available to all of you on the call, that we offer our members. The whole idea of this webinar series is educational. If it drives business, that's great. But we're a partner of yours. We want to make sure how important marginal cost of funding is, in particular given the interest rate environment and we're at, where we've seen a tremendous surge of money into the banking industry. What happens when that money leaves? Does it force us to make irrational pricing decisions? Hopefully, if you use the marginal cost of funding technique, you'll be pricing at the margin, offering products that are attractive, and able to make more money. Second step, review your analysis. You planned on raising $10 million in new deposits, but your cannibalization rate of 2% gave you an additional $8.9 million in deposits that were priced at 54 basis points. Now they're priced at 130, a rate increase of 76 basis points at a cost of $67,872. Net, if you compare the $10 million from your CDs to the $10 million of the Federal Home Loan Bank, you're going to be better off pure rate-wise using the new product. However, if we quantify the marginal cost of those roughly $9 million that flowed from a lower costing alternative to a higher costing alternative, you can see that our cost was $197,000, $52,000 more than if we'd have just went with the Federal Home Loan Bank alternative. My marginal cost of raising $10 million of net due deposits, taking into consideration the cannibalization, is $198. The cost of a comparable Home Loan Bank advance is $145, 53 basis points higher. Almost $52,872.49 was the difference. So it's important to understand that typically, it doesn't happen all the time, but a lot of times when you run a CD special, you attract new money, but you also migrate funds from a lower costing alternative to a higher cost alternative. That's why it's important for all of you, if you can, to know that cannibalization rate. Slide 29, please. There are hidden costs of cannibalization, and they can be very expensive. In this case, you'd planned on raising $10 million, which you did, but you also got another almost $9 million that moved out from a lower costing alternative into a higher cost. So a 2% cannibalization rate on $446 million is expensive. The cannibalized balances totaled $8.9 million and repriced from about 54 basis points to 130, or 76 basis points increase. So what the model can do here is we can calculate break-even rates. We can calculate, based on a 2% cannibalization, how much can I increase those by in order for me to still be in the money of not taking the advance. In this case, it's only 6 basis points. The promotional rate, or you could say the promotional rate on the new CD has to be 119, or I have to reduce the cannibalization rate to only 1%. So the tool has the ability to calculate for you break-even rates. Now, that's not to say that based upon this analysis, you don't decide to go ahead and do the strategy that you put forth. This just allows you to quantify what could potentially happen if the past is prologue. What you've seen in the past actually happens this time. You can actually quantify at the margin how much it's going to cost you to raise that funding. To summarize, so Brett talked about defensive pricing strategies, so let's kind of backtrack a little bit. We talked first about marginal cost of funding. We gave you a background. We walked through the mathematical formula, how it's calculated, the change in the price of your deposits divided by the changes in the balance of your deposits. We talked about why marginal cost of funding is important. We talked about the assumptions you have to contemplate. Then Brett migrated into defensive strategies where you're playing defense. Should I pay up or should I stand pat? And then I moved into offensive strategies. Here maybe you have a vulnerable competitor where you have an opportunity and you want to seize upon it. You want to evaluate all of your pricing decisions at the margin using the marginal cost of funding tool. So in terms of offensive pricing, you run offensive specials when you need to attract funds and when the marginal cost of funding is not substantially above your bogey. I mentioned that you have the Federal Home Loan Bank curve to use as your bogey. You don't have to. It's just readily available. It's easily accessible. Any one of your pricing team could pull up our website and figure out what the cost is. It's published every day on our website free. Developing an appropriate funding bogey for every deposit account is helpful in making deposit pricing decisions. I mentioned that the advanced curve is a very good bogey to use. It's readily available. We have many different tenors of products. Analyzing deposit pricing decisions on a marginal cost can and should be used as a part of your strategic planning process. The Federal Home Loan Bank of Des Moines Marginal Cost of Funding tool can assist you in quantifying your marginal cost of funds analysis and pricing campaigns. We have another poll. This concludes our webinar. As far as prepared results, we have a poll to run, and then we will address any questions that have been typed in the chat. I'll come back on after the poll results. The poll question is your institution running or considering running a CD special? So it looks like 56% are yes, 44% are no. Those are good. Hopefully, during the course of this webinar, Brett and I have demonstrated the importance of evaluating all deposit pricing decisions on a marginal cost basis or at the margin. Our intent was not to discourage institutions from running CD specials or aggressively pricing deposits. Rather, our intent was to encourage a thoughtful and quantifiable approach to economically pricing deposits at your institution, given the likelihood of the FOMC continuing to increase rates. We certainly hope that all of you will join us in the next 3 webinars in this series. The next scheduled webinar is Tuesday, August 15th, and it will cover using term advances to make loans your customers want. I want to thank all of you for your time, and most importantly, thank you for your business. This webinar has been recorded and will be placed on the website for future reference. Do we have any questions in the chat room? Okay. So we have been able to answer all of your questions. We certainly look forward, hopefully, to hearing all of you listening in on our next webinar, August 15th, same time, 1 o'clock to 2 p.m. Central Time. If we don't have any further questions, this webinar is concluded. Thank you once again. We apologize for the technical difficulties. Thank you for your patience. Thank you for your business, and have a great day.